Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, October 11th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, we kicked off October on a kind of an upbeat note after a miserable September. Came out, bulls charged out of the gate. We had 2 days of weak manufacturing data and construction spending, coupled with a sharp drop in the JOLTS, which shows the job openings dropped by 1.1 million, and the bulls got energized with that and thought that maybe we could see the Federal Reserve pause on their rate hikes, which is kind of a little bit of a pipe dream. Then we came up on Wednesday, and we got 3 days worth of jobs data that really just knocked the wind out of the bulls again. And during that 2-day rally, we had the Dow, it surged 1,590 points, up about 5.5%. The NASDAQ matched it; it was up 5.6%, and every single sector was positive. Of course, we're coming off of very oversold conditions, but leading the way higher was the energy stocks, oil and gas, and everything. That was up about 10%. But then with the strong jobs data, of course, that pushed yields higher again, and then equities lower. And as that data was coming out, we also had several Fed members coming out saying that they didn't see signs that inflation was peaking and that rates needed to move higher to get inflation under control. And that, of course, is not what the investors want to hear right now. And we had, I believe, it was the 10-year was floating with 4% for much of for a couple of days, I think on Wednesday or Thursday. Then it ended up somewhere down around, I think we're down around 3.85, something like that. But it's, the rates are staying up there. We had the CME Group FedWatch Tool was projecting about an 80% probability after that jobs data that we would have a 3/4 point hike at the November FOMC meeting, which actually now is about 2.5 to 3 weeks. So we don't have long to wait for that. But as the market sold off, we did stay above. We were able to stay positive for the week. That's basically because the strength of those 2 days was just more than they could, more than the bears could sell off. We had energy was up about 13.5%, and then we had solid moves in industrials, materials, communication services, and financials. They were strong. Now the rate sensitive sectors, which include REITs and utilities, they were the weakest groups, followed by consumer discretionary and consumer staples. Now, consumer staples have been kind of going sideways a little bit in here the last couple of days. A lot of that's because we've had some upgrades on food stocks. I know Kraft Heinz was upgraded yesterday. Procter & Gamble made some decent some guidance a little bit also. So that's looking okay. But again, the growth stocks and technology stocks especially are still struggling in here. Technical condition, the market was kind of mixed last week, mainly because you started out so strong, and then the bottom kind of fell out of it. But the move that we had those first 2 days at 1,500 points was tough to erase. So we did end up positive for the first time in 4 weeks. That snapped a 3-week losing streak. The Dow Jones, the S&P 500, the Dow Jones Transportation Index, and the Philadelphia Semiconductor Index, they were coming off their lowest levels since November 2020. I think we're still above those levels today with yesterday's selling again, and today we had an early stop. This guy's staying there, but the NASDAQ actually, NASDAQ Russell 2000 did hold the June lows last week, but I think they broke them yesterday, if I'm not mistaken. And the NASDAQ was actually earlier today down to where it was in, I believe, September, October of 2020. So it's having a hard time. mainly with the semiconductors. Part of that was where we had the White House was they put more restrictions on chip stocks going to China, and that knocked the Chinese stock market and Asian markets in general sharply lower yesterday and again today. Yesterday we had the Philadelphia Semiconductor Index actually dropped, I believe. Let me see here. I think it's about 4%. Let me check that real quick here. Let's see. Yeah, that was almost 3.5% yesterday. That was another 1-year low for the semiconductors. NASDAQ broke down to its lowest level since November 2020. It was down to about the September 2020 this today. I gave some price targets over the last week or two that we're looking at. We're getting close to them, especially on the NASDAQ with today. Now, the Dow Jones, we had a target. Let's see. The downside target of the Dow Jones is 27,942, and that's going to be followed by the 50% retracement of that whole rally from the March 2020 lows to the January 2022 highs. And that 50% retracement level would be around the 27,580, 27,600. So it's probably, I would say, at around 28,000. You may start looking around there. We may try to see the market try to, find a bottom. The S&P 500 was also is getting close to the 50% retracement level, and that is going to be. We had 3528 target for the S&P 500. That's followed by the 50% retracement level. That's going to be around 3490, 3500. So probably about 3500. We may see some support come in, some buying coming in. The NASDAQ had already retraced 50% of its rally, and it has support down here at around 10,268. So it's struggling to find some firmer footing down here, but I think it's going to have a little bit more weakness in here, so it's going to kind of have some pretty choppy trading going back and forth. Now, there were some signs the bulls could hang their hats on, not a lot. However, we talk about the secondary indexes, how we'd like to see those indexes, lead the market higher and lower. And we did have the Dow Jones Transportation Index and the small cap Russell 2000. They actually outperformed the broader market. So that's just something that maybe they're trying to put a bottom in. I won't read too much into it yet because the underlying breadth for the different indexes is still weak. We had the NYSE and NASDAQ advanced decline lines both took out the lows, the low on those lines from the June lows. So that's showing that stocks still remain under distribution. As far as new 52-week lows go, we did see some contraction in that, but that after you bounce up 1,500 points, you're going to have you're just not going to be making that many new lows. We are seeing a little bit more expansion to yesterday. I'm not sure what we have today. I have to take a look at that later on. As far as sentiment goes, we did see a little bit of an uptick in bullish sentiment last week. Part of that, the big increase was actually in the hedge funds. We saw the National Association of Active Investment Managers exposure index jumped from 12.6% the week before all the way up to 38.1. I think what they're trying to do, there was two reasons for that. Number one was that, I think part of that was related to end of the month and also end of the quarter window dressing. When their statements come out later on in the year, towards the end of the year, so they want to have exposure to certain stocks that they may have dumped on the way down here, that they want to show that they're back into those. So that probably had a lot to do with that. I would expect to see maybe a little bit of a fall off on that. We'll find that out on, I believe, Thursday. And then the retail investors for the American Association of Individual Investors, it actually had a little bit of an uptick in bulls, not much. They did actually finally break back below 60% on bearish investors. They had 2 weeks of a row where we were almost at 61% of individuals were bearish. That's only happened 1 or 2 times in the whole history of the times they've been keeping those. So anyway, what we're looking at right now is we still have about an 80% projection rate for a 3/4 point hike. Obviously we this is Tuesday afternoon. We're having this, and we were down across the board early, but then we had a midday bounce, took all the major averages back into the plus column. We'll see how that lasts. We were up almost 400 points earlier today. Right at the moment, we've given some of that back. The Dow's only up about 270, and the NASDAQ has gone back into the red. So that's it's having a hard time sticking. I'm not sure exactly why the turnaround was that much. I think maybe you're maybe you're getting some traders that are trying to get ahead of some of the reports that are coming out later on in the week. And but right now, earlier today, we were getting a 10-year coming up around the 4% level. That seems to be an area where it actually touched 4% today. So that's something that they've been watching. That was right around looks like around very early. We touched 4%. Now we're back down to around 389. So it has backed off just a tad. But right, as I said yesterday and last week, I wouldn't get too excited about these bounces. In a bear market, you always have very sharp moves up and down. They seem to always trick investors. If you're on the sidelines, also you see this market taking off. A lot of times you'll see people jump in because you don't want the train to leave without you. I wouldn't be too worried about that right now. You've got a market, some of the indexes are down 35% or so, and you're going to have some problems. You have time to jump back in, and you're not going to. I don't expect this thing to go back to new highs anytime soon. I would be surprised. I think as some of my work, looking at resistance levels and stuff, if we start to firm up here, we get these slowdown in the rates. I think we can maybe make another run to maybe 4,000 on the S&P 500 by the end of the year. But of course, we'll have to see what happens with the Fed. They still control, where the market's going here over the short term.
All right, so we got some key reports on inflation this week with the September PPI and CPI. And then earnings roll out on Friday. Is today's rebound just traders getting ahead of the news, hoping we get lower numbers? And would you be a buyer here?
No, I wouldn't. We're still looking at probably a 3/4 point hike on November 2nd, unless you're really surprised by these numbers. But just from what you hear on from the companies themselves coming out, they've got a big build up in inventory because when you had supply chain issues, they were over ordering, bringing in more supplies. That started to loosen up a little bit. And now with a slower economy, they're starting. The retailers are going to start discounting stuff more than they hoped to do because they've got to clear out some of their inventory. But right now you're getting kind of another bit of an oversold bounce. You had 4 down days in a row. They're hoping that maybe we'll get a little relief in this PPI and CPI as the September numbers are coming out. The PPI is tomorrow. CPI will be Thursday. The fact is if we see a bigger than expected drop in either one of those, you could get a rally of 600, 700, 800 points in the Dow. But how long that would last, we'd have to see because they're still talking about the raising rates. But the main point here is that this is just people getting ahead that they're hoping that they're going to get something that where the Fed comes in and says, maybe we're going to let off the gas here. They've already raised rates higher and faster than ever before, I think, in history. And with what we talked about last week with Volcker, you need to keep rates a little bit higher to actually crack the inflation thing. If you stop too early, is what he did back in the 70s and 80s, then all of a sudden the inflation started to come down, then it turned around and went right back up. Then he had to raise rates again, and that caused a double recession, and that's what they're trying to avoid. But the problem is we've never had them raise this high this fast, and part of that is they waited too long to begin raising rates. Now they're trying to catch up, and they may be hiking rates too fast. You've got a lot of analysts saying that they need to stop, just to watch and make sure that we're starting to see some progress, and not throw the economy in a big recession. You're also going to get some political pressures coming up here. The Fed is independent, but with midterm elections coming up, obviously there's going to be some meetings that we don't want to see the stock market in the pits going into the into the elections. That's not going to be good for the Democrats. So what I would expect would be see some pretty volatile a few days. You're going to have they're going to have the one side is that doesn't think inflation's peaking, and they're thinking the number could come in above expectations like we had last time. And then, of course, on the other side, they're hoping that you're going to see a bigger drop. So we'll see that. Then on Friday, of course, we had the money center banks. They're going to roll out the third quarter earnings. That'll give us a little bit of a hint how much the rate hikes have slowed the economy. And so far, from what what you read, the banks are saying loan growth has been okay. Countering that, though, you had J.P. Morgan CEO Jamie Dimon yesterday said he sees a recession ahead about 6 months, and the stock market could actually go down another 20% drop if we if we are going into recession. The market seems to look about 6 months ahead, so perhaps it's telling us that we're in a recession now, making these new lows, and we can start to bounce off here. But again, the focus will be on forward guidance, and we want to keep an eye on that. Now, the last thing I just want to bring up, and of course you can't read anything or watch the news without seeing the geopolitical tensions that are going on. Of course, Putin keeps threatening to use nuclear bombs. If he does that, we can see a market fall out of bed. You had some big time investors over the last day or two talk about that they are actually kind of hedging portfolios, buying puts going out a couple of months just in case the fighting would intensify. That's basically they want to be exposed to some risk in the market. But then again, they do know that if an atomic bomb went off, or a nuclear bomb went off, we'd have some probably lower prices across the board. Now, one thing I did want to mention, can you go click on industry group analysis? And when you get to the industry group analysis, go to the relative strength. Click on that twice. This is something that our subscribers can look at. Okay, if you hit relative strength, the far right column, that shows you how these different industry groups are performing against the S&P 500. As you can see, there's still a lot of them that are outperforming the S&P. We talked several weeks that energy would be one place that we would want to be exposing ourselves if we're going to pick up some stocks. You can see that oil field equipment, oil secondary, oil field drilling, they're all outperforming the S&P by 18 to 27%. You got a little deterioration in oil field drilling. We'll have to see how that is. Diversified mining is good. Banks, banks will have to kind of wait and see what's going on here as they start to report earnings. And normally when as rates rise, the financials would be a good place to go, but if you go into recession, they're not such a good place to go because you have the yield curve inversion. So that's tough. Then you go on down the line, you have food, which has been improving. Like I told you, remember, consumer staples is looking good. Had an upgrade to a buy on Kraft Heinz yesterday, which kicked the stock up. But another one down here I was looking at, if you pick something, go down here on page 2, Will, to aerospace and defense. You can click on that. This would be something you might want to take a look at if you're worried about what's going on in Ukraine, as we're starting to put more and more weapons that are starting to intensify. You have stocks in here like Lockheed Martin. It was downgraded to a neutral, but power rate is still 29. You have some other ones here. Raytheon's not on here. RTX is a good one. They make a lot of the missiles that are flying out there. You might be able to find some of these that are starting to take off. And if you click on the 5-day percent change, I mean, you have these a couple of these. Here's this SPR. It's an avoid, but over the last 5 days, it's up 9%. Once you hit in Boeing, it's up another almost 5% in a week. Some of these stocks have just started to, they're starting to take off as you start to see these, as they start to escalate the war over there. Some of these other countries are buying more and more missiles, that type of thing. If you go back to the industry group homepage one more time, what I do sometimes is click on the 1 week percent change, click on that twice. And again, this will kind of show you what they're buying here over the last week and a half here, and paper products, food retailers. We just talked about that. Over the last 1 week, the food retailers are up about 3%. That's pretty good. So if you look on that one, you'll probably come in here and you'll see. Let's see. You have, I don't know all these names. You have Kroger. A lot of these are avoid, but as you can see, with the things up 3.5% over the last week, these are going to start getting upgraded. They've already pretty much may have bottomed out, and we may be able to see these things start to pick up. In fact, if you look at the chart on food retailers, it looks like it may be trying to put in a bottom up there on that. So if you go into that and look for that, another 1 week percent change, it might look good. Let's see, building material looks okay. Coal has done okay. Part of that is because China's they're coal, burning up coal like crazy. But if you look at some of these things, if you look at the 1 week percent change and then click on the name of it, and you're going to find some stocks that may be not stocks that you normally would buy. I'm not a Kraft Heinz guy. I'm not a big defense type of guy, but these stocks have been doing well for me lately. I think that as we go into a slower economy, we're still going to eat. We're going to be looking at some of these things like the Procter and Gamble's and stuff like that that are having products that you're going to need whether the economy's slow or not. And this is a place where you can find some of these areas that are sectors and industry groups that you normally don't look at. But if you come here, you'll see that, everything, my Microsoft's down 50%, my NVIDIA's down 70%. I'm losing my butt on these things. Well, if you still have some cash, you might be able to begin to start to put some of these to work on some of these sectors that are will do well in a recession or even if the economy slows down. So, and I'm not saying to run out there and put all your money to work in these things by any means, but it might give you some exposure to cut some of your, to maybe make a little bit and put you in just rather than just have all your money in cash to nibble away at a few of these industry groups and sectors that could give you a little bit of a return in here. But anyway, let's see what happens on Wednesday and Thursday. This is going to be pretty big reports. You can see a lot of volatility off of these things. And I'm not going to say whether the market's going to go higher or lower, but you'll be able to tell pretty early as these things come out about 8:30, I believe, and then you'll see the futures whether they beat the numbers or whether they came in weaker than expected, and see how that goes. All right.
All right. Sounds good. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it in support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tech Talk. Thank you for tuning in, and we'll see you next week.